Okay, good morning, everybody. I'm Steve Kaplan, and this is a panel on AI and the future of finance. And I'm really excited to be part of this because I know nothing about AI. Monica asked me to do this, and I figured I would learn something, so I'm looking forward to this. We have an awesome group of speakers. Tania, Babina, Andrea, Eisfeldt, Dimitris, Papanikolaou, Toby Moskowitz, and Lauren Cohen. And so we have actually, it's broad perspectives and from all very good people. So that's who's talking and in that order. And let me just start off by saying, what we'll do. We've got 2 hours. I'm going to give a brief overview. And then each speaker has 14 minutes to talk, and then 7 minutes for questions from you. And I'm hoping we get questions from the audience because, again, I think there's probably, since AI is relatively new and changing quickly, I think there's a fair amount of expertise in the audience that can be useful. And I have questions to ask too, and then we'll have up to 10 minutes for general discussion at the end and maybe more. So that's what we're going to do. And just as an overview of what I hope to get out of this, I went to Claude and ChatGPT, and I said, what should I ask about AI and finance? And they were pretty good, actually. If you aggregated the two of them. And how will AI affect academic research? And I think you'll hear some about that. How will it be used to make trading and investment decisions? And can AI do better than humans? How will they transform strategies and fund management? What new and innovative financial products, markets, services, can AI bring? Can AI avoid future financial crises? That's a big one. Will AI lead to more efficient markets or less efficient markets? And I'm going to ask the panel if they have some rapid questions we can ask that. How it's going to impact financial advisory services and wealth management, and in particular, can we go to robo-advisors even more than we have? How can AI aid financial inclusion and provide financial services for the underserved? Can it make it more affordable and accessible, or I guess I can say less? What will the impact be on jobs and finance? Can AI be used to detect financial crimes and fraud? Luigi would be very interested in that. As financial institutions rely on AI, what about cybersecurity? And lastly, what ethical concerns arise from using AI? And there are a lot of potential ones. And then last and worst, what regulations need to be put in place? So lots of questions, and I think a lot of the speakers will have something to say about that. So without further ado, I'm going to hand it over to Tania. You don't have slides.
I don't have slides. Thank you so much, Steve, Monica, for inviting me today. As a brief introduction, my research focuses on studying drivers of innovation, its economic impact. And a few years ago, I got into researching how firms use AI and what kind of impacts it has on their performance as well as labor. This panel is about the future of AI in finance, but I find it hard to talk about the future without having some context for the past and present. So my goal will be providing a broad overview on what's been happening in AI and finance, and specifically when I'm a corporate mostly person, I'll talk about how firms use AI, what kind of impacts it has been already having, as well as some brief overview of the research that I and co-authors have done. Okay, so that's the game plan. And please prepare your questions afterwards. Steve pointed out, it would be great to learn from all of you. All right, so past. As you might or might not know, research in AI has existed for decades, but there was very little commercial interest in AI until about 10 years ago. Since then, over the past decades, has seen tremendous rise in investments in AI by firms, where the three key areas getting most investments: machine learning, natural language processing, and computer vision. So when I say AI, this is what you should think about, these interrelated technologies. And these core AI technologies are different from traditional statistical methods of analysis, from their ability to learn from vast amounts of high-dimensional, structural, but most importantly, unstructural data to make better predictions. So what drove this big interest in AI? Two big factors. One, there was big improvements in the performance of AI models, algorithms, and two, there was a plummeting cost of deployment of AI tools. This was mostly driven by decrease in storage and computation of data, things like services like AWS, chips from NVIDIA that specifically targeted for computing and ML made these technology commercially feasible, as well as data accumulation, right? Digitization and very rapid accumulation of data. This is what the AI is built on. All right, so in terms of development of AI research and adoption by firms, US has been a global leader, both in terms of volume of cutting-edge research in AI, as well as adoption by firms. So by now, think of about more than 50% of US public firms have some kind of investments and use of AI. And how firms have been using AI so far, in mostly two ways. One is internal AI investments, hiring ML engineers, training your models inside the house, building the ML-powered systems, and then plugging them into products and services. And I'm going to have a few examples in a second. And the second one, using external AI solutions. One of the famous ones is IBM Watson, that helped firms to train their models in these external solutions. Okay, these were the two major ones over the past 10 years. Now, how have firms used AI? Well, it's important to remember that at the core, the AI is a prediction technology, right? And where predictions are useful, well, where there is uncertainty, right? And where firms face uncertainty, practically everywhere. And indeed, consistent with this, industry reports tell us that firms use AI in all kinds of applications. But one of the biggest one that's consistent across many types of firms and industries is using AI for product innovation, for development of products and services. This might be surprising, given the public discourse about AI killing all the jobs, but it shouldn't be surprising to us finance folks who know that where most money to be made from creating awesome products, right? And product innovation, firms face a lot of uncertainty. And so AI helps to expedite development of products as well as creating them. Okay, let's dig into some examples. In pharma, AI is being used to develop drugs and vaccines. For example, Moderna have used their AI factory to develop COVID-19 vaccine. In healthcare, AI is being used to customize treatments to each particular customer. It's used for detection of diseases. In modern cars, industrial and agricultural machinery, computer vision systems help them to become much safer, right? In credit scoring, credit bureaus use new alternative data to improve their credit scores, especially in countries that already implemented policies like open banking that allow them access to richer consumer type of data. Many different uses, for example, in Morgan Stanley, a student of mine, like 4 years ago, developed internal system for their financial advisors to customize advice and wealth management services to their vast customer base. So this has been happening at many companies in many different ways. From surveys, we also know that firms have been using AI in other corporate applications, like forecasting, like risk management, like supply chain management, HR, and many, many other use cases. So it's been already deployed to solve many problems firms face. All right, let's talk a little bit about the present. What is the present of AI? Well, it's popularization of generative AI tools, right? I think at the core, they provide very similar functionality as already existing AI tools, but what they are, they're direct to consumer, right? Before, as I mentioned, the AI tools were available for a few firms and their employees to solve whatever problems they face. Generative AI tools like ChatGPT, DALL-E allowed us, in small firms, access to these tools at a very low cost. So I think this is one of the biggest changes that's going to affect development and adoption of AI tools across users. All right, so what does current research tell us about uses of AI by firms and potential impacts? I want to emphasize that this is very, very early emerging research, right? I think there is a lot of investments in AI already, but you and I will all need to figure out what are the potential uses, what are the potential risks. Steve mentioned some of them. What are the micro, but also macro implications of these uses, right? For example, the use of AI can affect systematic risk of firms, as in one of the studies with co-authors we find. Most of research focuses so far on specific applications of AI in specific setting. For example, Leah has a paper on using AI methods showing that board directors the selection of board directors can be improved with ML models, right? There is also use of AI in stock analyst ratings, in mutual fund performance, and asset pricing, credit underwriting, and my colleagues here are going to deep dive into some of these uses. But there is very little research so far on the impacts, economic impacts. What does AI actually do? Does it change anything at micro and macro level? But there is already consistent research that shows that firms that already invested, piled in early on in AI investments have benefited from growing their sales, market valuations. So firms already benefiting from incremental growth sales from using AI. And in a paper with my wonderful co-authors, Anastasia Fedek, Alex C., and James Hostin, we document that, consistent with industry reports, firms growth sales by using AI for product innovation, improving products, customizing products, and creating new products. We also find that it's mostly big firms benefit from AI. Why is that? Well, you can rent other inputs on a spot market to AI like AWS, you can hire ML engineers, but what's really important to have proprietary data, the secret sauce that nobody else has. And big firms naturally generate a ton of data, which raises a lot of questions about competition and access data and ownership down the road, and there is very active discussions in governments around the world how to address these things. So I think I'm going to stop here and see if you have any questions so far.
I have one question on big firms versus small firms. On the one hand, big firms have the data. On the other hand, what I've heard from some big firms is they're much more risk averse. Their lawyers won't let them do anything. And therefore, it's going to be the small firms that are going to experiment.
Yeah, so far, what we've seen, what are the biggest impediments to AI adoption? And one of them is getting management on board. If you have management on board, then I guess lawyers get on board too. So that indeed was one of the frictions. But so far, there is actually consistent data from our work and from new survey by US Census colleagues. They have a cross-section of kind of survey who's using AI. And Steve, it's pretty consistent so far that it's mostly biggest firms pile on. But as I mentioned, with the democratization access to these new generative AI tools, I think this is where we can see the shift from small firms, entrepreneurs, self-employed people starting to use, and I have some anecdotal evidence showing that self-employed just increase their productivity by using these tools because they often don't have lawyers over them.
Just to follow up on that question, are you seeing more collaboration between firms, especially smaller firms, to share data, or what do you think some of the impediments are there? Because you could imagine a bunch of small firms, especially in the same market. There's obviously they're worried about competition, but they also could all benefit from sharing some of that information. There's been other instances, like in real estate, where that has been successful. But how do you see that shaping out?
This is an awesome question. One of the things I wanted to talk about, but wanted to make sure I'm 14-minute limit, not to. Okay, so there are two sources of training data for ML models. One of them is proprietary from firms, right? Examples, your bank, JP Morgan, sees my transactions. It can better assess my credit worthiness. Or fraud detection, right? Like banks became so much better by using our transactions to figure out what is potentially fraudulent, what not. Again, that's based on internal proprietary data. Or to compare and contrast, Adobe has a huge database of images from their Photoshop, right? Because when you sign up using it, somewhere in the long list of conditions of use, you give away the right for them to use your data. So what that allowed Adobe to do is to create very successful Firefly service that generates images based on text prompts. Right, that's all based on Adobe internal database of images. Contrast that with the other main source that's been used for training models like ChatGPT, DALL-E. It's internet. It's everything that's available in internet, right? Companies like OpenAI, DALL-E trained on a bunch of images available online, and that created a lot of legal issues, right? Like who should benefit from all of this data created out there? And there's recent New York Times lawsuit against ChatGPT. You might have heard. There are a bunch of them, right? So I think from a regulatory perspective down the road, this is going to be one of the key issues to talk about and think through, which is what are the IP rights in terms of, and how to allocate rights to ownership and beneficiary interest to data. Does it answer your question? Yeah. Okay.
Question? Yeah, come to the mic. This is being recorded somewhere in the cloud, so
be nice to us.
Be careful what you say.
I mean, wow, there are a lot of people in here. Hi, I'm Matt Kowalik. I'm wondering if you could speak more to the capital and physical inputs to running, larger models, because it's not just the necessarily the labor knowing how to design things, but there's also the whole setup of the giant data centers that some people utilize for storing things in the cloud, for buying the right kinds of GPUs to actually, train models efficiently. And there's a whole other ecosystem around that, but could you speak a little bit more to that, possibly?
Yeah, so I need to be humble and acknowledge that I don't think we have a systematic estimate on what fraction of costs constitute more intangible inputs versus more tangible. But from anecdotal evidence from all we know, this is where cloud computing services and storage, which let you rent capacity, play a big role. I mean, in Texas, you probably heard about vast servers located here where there's a lot of sun. So a lot of that infrastructure is provided by companies, tech companies that provide services where you can store and compute your data. This poses another important question, which is one of the externalities of using ML is environmental ones, because churning these models takes a lot of energy in, and I didn't see this addressed in any kind of regulative framework so far.
You mentioned the plummeting cost of AI, and you just talked about the big energy consumption. Now, will AI be more like the decoding your genome, where the cost just continues to plummet and the energy consumption will become reasonable, or do you see it as a permanent cost of AI being extraordinarily energy intensive?
I think I'm going to take this at a very high level. I think there is choice to be made. Like, one way we can organize a lot of AI tools as public utilities. Like, all of this race between, OpenAI, Google, Meta to create this, large language models and compete with each other. Maybe competition is good because it encourages improvement in the model, but at some point, all of them consume humongous resources in terms of, processing that data. So I think maybe in the future, at some level, when we reach the quality, you don't have to have 10 firms doing the same thing. You can have one public utility. But that's, up to the discussion by policymakers about how we want to, as a society, to organize some of the tools that should be available to everybody, right?
So I'll just give you an anecdote. I talked to, this was a Fortune 50 CEO 6 months ago, and I said, what should we be thinking about, as academics? And he said, get as much compute power as you can, period. And that suggests a different answer to that question, that it's going to continue. It's all about compute, so we'll see.
Yeah, but to counter that, innovation and progress is not static, right? So far, there has been significant developments in quantum computing, right? It's coming. And once they're there, the costs to processing data are going to be much lower. So, I'm optimistic that innovation is going to solve a lot of problems.
Great. I think that is perfect timing, so thank you. And now, Andrea. Let's find Andrea. There you are. And there you go.
Okay, thank you. All right, well, I'm very excited to be here. I'm going to talk about a paper that I have with Gregor Schubert, who is here in the audience. I just saw him somewhere in that direction. And Ben Zhang, that's at USC, and Bloody Tasca from Lightcast. So I'm going to focus exactly on the title of the first slide, which is the impact of generative AI on firm values. And there really can be two very obvious channels for an impact on firm value from generative AI, and we're going to focus on this first one, which is productivity improvements that are going to come from the labor exposure to generative AI. We want to think of ChatGPT as truly a general purpose technology that's going to affect a broad array of companies and industries. And to improve productivity, ChatGPT can either be a complement or a substitute to your existing workforce. And I know we're all thinking all the time, is GPT a complement or a substitute to our own jobs, right? Or to our own labor supply. We're going to find that there's evidence of substitutability overall, but we will find complementarity for certain occupations, and that's kind of how I'm going to conclude, so I'll leave a little suspense there. The second channel is a direct product market channel, and that, just think NVIDIA, and we're going to have to do a really good job of controlling for that direct product market channel to show that the labor channel is robust to excluding and controlling for it. And I think it's really interesting because this labor channel does show up immediately in the 2 weeks after the release of ChatGPT. And that is in November of 2022. So I'm going to show this AMH portfolio, and Toby and I worked together for a time at AQR, and I learned that 3-letter acronyms can be very powerful. So this is the artificial minus human portfolio. The only difference between the kind of 3-letter acronyms we're used to from a French, AQR, et cetera, is that this is a cash flow effect. We're doing kind of a difference in differences event study, and we're looking at the returns to this AMH portfolio, artificial minus human, in particular in the 2 weeks following the ChatGPT release. relative to the sample that starts thereafter. And you can see the blue line is the AMH portfolio, the drop line is the ChatGPT release, and I'll tell you more about this graph after I do some measurement. So the outline is going to be, with that preview, the impact of the generative AI shock on firm valuations. So we are actually, I believe, the first to be able to talk about the impact of ChatGPT on firm values, because we are aggregating the labor force exposures up from tasks to occupations to the occupational mix at firms using Revelio data. We're going to look at the cross-section of returns, and we are going to do the horse race against product market effects, talk about the evidence of data complementarity, which Tania already alluded to. Why would we think necessarily that the firms that are already publicly traded would benefit from the introduction of a new technology? It could be that new entrants could benefit. But as she said, the existing companies may have very valuable data corpuses, and that may prevent new entry, in particular in some industries. And then I'll talk about this evidence of both labor substitutability overall and complementarity for certain occupations. So again, we're going to build up this labor exposure to generative AI from tasks to occupations to firms. The idea is, can generative AI do the tasks in your occupation? So ONET has something like 19,000 tasks and 900 occupations. And then we're going to aggregate that up to firms using the occupational mix at the firm level. So we are basing our task and occupational exposures on work coming out of OpenAI by Elanju et al. And let me just talk about the way we measure those exposures using some examples. So we are using ChatGPT as our research assistant. So hopefully ChatGPT is doing a task that is supplemental to my occupation, not core. And it is just analyzing the data in these tasks, the description of the tasks itself. So the first one here is the occupation is web developer, and the task is to evaluate code. ChatGPT can already do this 50% faster and at equal quality. It gets a score of 1, right? What about the occupation bioinformatics scientist and the task of basically combining proprietary genomic data with publicly available data, or private data on health with publicly available data? ChatGPT can help, but it needs additional software overlay. That gets a score of 0.5. And then we move to HVAC installers, and ChatGPT cannot connect heating and cooling. It just, can't do those physical things. And this is one of the ways it's very different from the prior waves of automation that we've seen. And we go to occupations by basically just summing up over those tasks, the share of those tasks in the total tasks of the occupation. We get very intuitive results that the high exposure occupations are things like telemarketers, proofreaders, bookkeeping, mathematicians, and computer programmers. The low labor exposure occupations are very manual oriented. And in fact, 17% of BLS occupations end up with a 0 exposure to AI. And that's because the tasks are more manual there. Okay, I mentioned that this is different from prior waves of automation. This is the relationship between wages and labor and sort of occupational exposure built up from task exposure to generative AI. And on the right-hand side are the higher wage occupations like computer, mathematical, legal, management. And on the left side are the lower wage occupations like food services. And you can see that the exposure of your occupation is increasing in your wage. So this is, something that makes a lot of people nervous when we give this paper. So just wait till the end and we'll kind of end on a high note, I think. So we get to the firm level in the same way. We just aggregate up by the employment share at the firm level, each occupation. So the employment share of that occupation times the occupational exposure. This is just from the list of 100 largest firms because I want you to recognize the names. Large firms with high labor exposure to generative AI, Intuit, IBM, actually IBM at the top, Intuit, NVIDIA, S&P Global, and PayPal. So yes, we've got the tech firms, we've got information firms, we've got finance firms. large firms with low labor exposure to generative AI, at the bottom is actually Starbucks. So we can all be thankful that we get to go to Starbucks or Alfred's or whatever our pleasure is. McDonald's, Dollar General, Union Pacific, and Northrop Grumman. So this mix tells you that we have to make sure that things are robust to industry, in particular the tech sector. And I will tell you that we do our sorts first within industry as a robustness check, and we find essentially the same results at 10 basis points lower out of 42 in terms of returns, and I'll come back to that. So why is that? Why can we get the same returns when we sort within industry? Well, it turns out actually this is a general purpose technology, and there's a huge amount of dispersion within each industry in the labor force exposure to generative AI. So the blue dots here are the average exposure to generative AI through the labor force of each industry, and the red represents the dispersion within the industry. So you can see there's just, as much dispersion within industries as across industries. So there's a lot of room for winners and losers, and room for winners and losers within industries as well. Okay, so let's get to the firm level. Let's talk about the impact on firm values of the release of ChatGPT in November 30th. 2022. So what are we doing? We're doing something, very standard in finance, but instead of looking at risk exposures and expected returns, we are looking at labor force exposures and changes in expected cash flows around this event. And we're doing a difference in differences. You can look at the pre-trends in the paper, because we are looking at the returns following the release of ChatGPT for the highly exposed firms in the portfolio top quintile artificial, minus the lowest exposure firms, Q1, the human-oriented firms, the ones like Starbucks. Now, one important thing to note is that following November 30th, 2022, which is when ChatGPT came out, and this is the big release, because as Tania said, prior to that, people could use it, but it was kind of niche-y. It was kind of, for coders or computer scientists or people who were really in the know. That November 30th release was when we all got to use it. It was when it became clear that this was going to be something that was truly available to all firms and all people. Over those 2 weeks, we had other things going on too, and it turns out that the overall market return was actually negative. So this is clearly something that is identifiable as an effect through the release of ChatGPT on these firms that have the higher labor exposure. Another thing in the difference in differences spirit that supports what we are arguing, that the higher labor exposure firms experienced positive returns because of the release of ChatGPT and because of the productivity improvements they would be able to realize, is that the AMH returns are actually insignificantly different from zero in the period following the 2 weeks just after the release. Okay, so this is a difference in differences event study. Here is the results back graphically now that you know more about what we're doing. The green line are the human firms. You can see them kind of going down with the market. The red line are the artificial returns. You can see the divergence there right after the release of ChatGPT. And then the blue line is the AMH portfolio, the long-short portfolio. Now, if you look a little further, you'll see actually another time where the blue line goes up and the red and green diverge. That is actually right around the release of ChatGPT 4. The reason we can't use that in our study is because that was anticipated. Once 3.5 was out, 4 was very anticipated. It's very hard to time the date, but I think visually you can see that there is an effect there too. Okay, so here's the same results in a table. I'm not going to spend a lot of time on this. You can see that in the rightmost column, the returns for the long-short portfolio AMH, that the daily returns are 42 basis points during the 2 weeks following the ChatGPT release. And then in the sample thereafter, they are statistically insignificant and basically zero. And at the bottom, I'm saying it's robust to controlling for FAMA French 5, excluding the tech sector in the same way Acemoglu and Otter do, and also to sorting within industries. Within industries, that 42 becomes, I think, 32. So we are also, in addition to those ways of controlling for the product market exposure, going to control directly. We have, I think, 4 or 5, maybe more ways to do this in the paper and its associated appendix. Here I'm just showing you controlling for 10K based AI mentions, which, NVIDIA would have quite a lot of those. And what you see is there is a positive effect from mentioning AI in your 10K, but it's not concentrated in those 2 weeks following the release period. So this could be, it's everywhere. So it could actually be due to firm characteristics like being a growth firm or something like that too. And our result is at the top, of course, robust to controlling for this product market exposure. Okay, perfect. So the last 2 things I want to talk about are data complementarity and labor substitutability and complementarity. So one of the, I think, very interesting things, and we talked about this already between the incumbents and the new entrants, is that within industries, having higher labor force exposure is not always good. Look at this industry on the left. It is real estate, rental, and leasing. So Toby talked about data sharing, but working in real estate, we know that things are very local. Deeds can be recorded at the county level, and at the bottom it says if your data's not ready for generative AI, then you are not ready for it. And so there can be industries that are not ready, and I think that they are ripe for some disruption. And we have various ways in the paper of controlling for the effects of data. Some are based on 10K. We use the Abis and Veldkamp measures. And all of these measures show us that the positive effects on firm value are much stronger when you have high data value or strong data assets, consistent with what we said about large firms too. Okay, let's conclude with looking at the labor effects. So as I mentioned, there is substitutability overall. So what we have here are worker level wages and occupation level job postings. And overall, if you have a higher exposure to ChatGPT can do more of your tasks, you get lower wages post-release, and there are fewer job postings in your occupation post-release because it can be replaced labor for capital. However, if you look at the bottom row, and this is where I'll conclude, this is the good news. If you are in an occupation where ChatGPT can do a large share of your tasks, so you have a high exposure to generative AI, but the tasks that ChatGPT can do are classified by ONET as supplementary versus core. So maybe for us, the RA stuff that ChatGPT can do is core, but the personal interaction and the idea generation and the really high level thinking is still human. Then actually, it turns out that you get higher wages and more job postings in your occupation. So this is the sense in which we have complementarity for those types of occupations. And I will conclude here. I have a QR code to the SSRN version of the paper that has a ton more details, but right now I will answer any questions that you guys might have.
So let me just ask a summary thing. What does this mean for finance academics? And what does it mean for finance practitioners?
So even before we had the results on using the ONET classifications of supplementary versus core tasks, the first thing I thought of when this question came up, and it always comes up because we think about what's going to happen to us, what's going to happen to our friends, what's going to happen to our kids, is that I think of Rosen's superstar model. I really think that what this is going to do is allow the people with a lot of skill to leverage those skills. So one of the alumni panels that I was on talked about GPT as, what is it going to do to our kids' jobs was the question. And the answer was, this is an engine. There are going to be a small number of people building the engine. There are going to be a large number of people as engine drivers. So I think that's really exciting. But I do think there may be a sense in which the engine drivers and certainly the engine builders kind of start coming from the higher and higher slices of the population, of the skill distribution, essentially.
Can I have a question?
Please.
So one of the biggest challenges for firm to actually use ChatGPT and build it into their products is that it requires ingesting their proprietary data into ChatGPT. And many firms don't want to do it. Steve mentioned legal issues, also competitive issues. And in fact, many big firms prohibited their employees from using ChatGPT because of these concerns. Have you guys looked at heterogeneity by this kind of legal exposure and variation in stock reactions?
So we haven't looked at it as legal exposures, and that was something that kind of made a caveat to me in terms of how many engine builders we'll need. I think, especially in the short run, we need those engine builders to basically build the internal generative AI, exactly for the reasons that you say. People don't want their proprietary data out, kind of looked at by Microsoft or OpenAI or anyone else. So I think we'll get that, kind of more engine builders to build the kind of customized generative AI applications for businesses. So there is this question about how much of this will be some sort of utility or service provided by a small number of institutions, and how much of it will be done in-house. One of the things we do, though, Tania was my discussant at the NBER Big Data Securities Conference, and she has, I would say, a long line of research on AI generally, is that we looked at your measure of occupational hiring in the kind of data scientist AI space kind of up to 2018. So kind of, is this firm ready for the arrival of generative AI? And that has a positive effect on the impact of the release of ChatGPT-3 on your firm value. And I think that makes sense that there are some of these firms that were really ready for this and are going to benefit more because they can keep it internal for now. Yeah, come to the microphone. How are you?
Okay, how are you?
Good to see you.
So my impression is that the development of and adoption of generative AI, it seems to be proceeding on two tracks. Just like you mentioned, some companies that I hear, some large companies, they are developing internal generative AI systems using the technology developed by ChatGPT, but then customizing it and making it internal so that the data, their proprietary data, remains in the internally within the company. Other companies, and I guess smaller companies, they are using ChatGPT, which is kind of dangerous because whatever whatever in proprietary data you submit to ChatGPT, then that becomes property or usable by ChatGPT, which they use to train the software. As we all received a note from Elsevier about this, about like giving guidance to referees and editors about not using ChatGPT. My question is, do you have some sense for how much of this this two-track what is the extent of internal development of generative AI systems by companies versus using the public source or internet connected and chat GPT and who is doing it? Do you have any sense of that? This is for any of the panelists. You guys have looked at it, looked at the data. So.
Yeah, so let me start with, when I say the impact of the release of ChatGPT, I don't think it meant the impact on firm value when firms realize they can have labor-saving or labor-augmenting technologies is literally them thinking they're going to use ChatGPT or ChatGPT 3.5 or 4 or whatever comes. I think it is the realization by the world that, hey, even though we kind of thought of this as something that only computer scientists or kind of the real more sophisticated techie people could use. This is literally something that we can build as an engine that can be used by pretty much most of our workforce. In terms of who is going to be using a public, it can be a private, private company service like Microsoft OpenAI, or it could be a government-provided engine. There are big fixed costs to building those. So I think, again, that's why we see some of the big firms benefiting most.
Okay, I think we're going to wrap up this piece. Andrea, thank you. And now move to Dimitris Papanikolaou. So, go there. And welcome, Dimitris.
Great, thank you. So I'm going to pick up the thread that Andrea and talk about the impact of AI on work in general. I'm going to talk a little bit about finance jobs as well. But I'm going to be focusing on AI more broadly, not just ChatGPT. So I'm going to talk mainly about the impact of AI on workers, and I'm going to draw a contrast between the impact of AI to past technologies, and then I'm going to be somewhat speculative and make predictions about wages in the finance industry. So the punchline I want to make is that I think AI is going to be both skill biased and de-skilling. That is, it's going to increase differences in pay across occupations, but it's likely going to decrease dispersion in pay within occupations. And I'm going to explain what that is. So much of the stuff is going to be based on some recent work I have with Brian, Larry, and Leonid. So here's how we think about AI. It's a general purpose technology that can be applied to a variety of tasks. And some of these tasks, AI can do a better job than workers. We're going to think of these as routine tasks. And for these tasks, AI is going to be a substitute. Okay? So the AI can do the same job as the worker without the worker. For these tasks, the price of this task will fall. For some other tasks, AI can help workers be more productive. So these tasks will tend to be more complex. They're going to be tasks that are harder to automate right now. So we're going to need still a worker beside AI. And so for these tasks, think of AI as being a better tool, so we might expect that for these tasks, wages will rise. Now, just to be clear, these are all partial equilibrium effects. I'm going to be ignoring some general equilibrium effects that comes from increases in labor demand if aggregate productivity increases. So here's what we do. We basically ask ChatGPT as well to score each task in ONIT for each occupation on whether we think AI is going to be a complement or a substitute for it. So the way we phrase for a substitute is whether AI can do the job without the worker, or at least with a very limited human intervention. And the way we code it as a complement is if we think we're still going to need the worker to perform the same task, but AI can help the worker be more productive. And then we also try to get a sense of what's the likelihood that AI can actually be implemented in these tasks. So here's some examples. I don't know how good your eyesight is, but these are chief executives. And Steve will be happy to see that for all these tasks, AI is a complement. Okay? So these are complex tasks that cannot be automated just yet. This is another finance profession, is securities, commodities, sales agents. So there you see that AI starts creeping up as a substitute. So it's true that many of the tasks remain they're still a complement, but making bids or offers to buy or sell securities, that's something that AI can do. Another example is just monitoring markets or positions. As you go across different occupations, you're going to see there's a different mix of which tasks can be substituted or complemented. Here's another one, which is essentially back office clerks. And then what you're seeing is that most of the tasks there can actually be automated by AI. Here's how each occupation's exposure to AI is either in terms of a complement or a substitute, depends on their level of wages. Okay, so that's on the x-axis. And on the y-axis is a measure of exposure. So what you're seeing is, quote, low-skill occupations, they're going to see their tasks being automated by AI. And to be clear, I'm not just talking ChatGPT here, I'm talking it's just AI more broadly. So you want to think about delivery drones, you may want to think about automated customer support. A lot of these low-end service skills are likely to be substituted for by AI. At the same time, you're seeing there's a mild skill gradient for AI as a complement. And so to some extent, we're going to see that the complementary effect of AI is actually going to be spread throughout the wage distribution with some mild skill bias. And you're going to see in a second why I view that as a mild bias. So let's contrast it to what happened in the past. So in the same paper, what we did is we went and classified the same set of tasks as either routine or non-routine, with the idea that routine tasks can be automated. And then we went through a list of breakthrough technologies, close to 1 million patents. And then for each one of these patents, we asked, what is the relation, what's the similarity between what the patent does and what the task is, and whether their task is routine or non-routine. So our view was that if there's a lot of new technologies that are related to a job's routine tasks, we're seeing more automation. And then we're seeing a lot of technologies that are related to this person's or this worker's non-routine task is likely to be a complement. So on aggregate, jobs that experienced a lot of automation exposure, they saw both employment and wages fall, whereas jobs that experienced a lot of labor augmenting or complementary innovation, so both wages and employment rise. Okay, so this is all at the job level. However, the impact on workers can be different. And here's how these exposures vary across. So contrast this picture with the picture that you saw before. So in the past, automation technologies were primarily centered in the middle of the skill distribution. That's when people talk about job polarization. It's not the customer support agent or the delivery, the DoorDash delivery people that got automated. It's people in the middle, people in the factories. So in that sense, AI is going to be different than before. And then second, you'll notice that the blue line, which measures the to what extent different jobs have exposure to technologies as a complement, is a lot more steeper than before. Okay, so what I'm seeing from this is that AI is going to be less skill biased than prior technologies. Okay, so this was all at the job level. What about an individual worker? So what we think is that within a job, AI is actually going to decrease pay differences across workers. Now, why is that? Well, you can think of two reasons why that is. One is that AI is going to level the playing field. If anyone can be a Python coder, the price to being a Python coder will have to fall. Okay, so if I'm an excellent Python coder, I'm not going to benefit much from AI. But if I'm a very average to middling Python coder, I'm going to benefit a lot. So what it's going to do is going to lead to skill compression within a job or within a task. And typically, that actually leads to the price of the task to fall. Similarly, you might actually see a lot of skill displacement. So it's really good at coding in COBOL, and now everyone can code in Python. That skill has become less valuable. Is there any evidence for this? Okay, so here's some recent work that people have tried to run experiments on ChatGPT and measure directly productivity. So what people find across all these studies is that ChatGPT actually increases the productivity of the workers that are less skilled at that particular task, be that either students at the bottom of the class or being workers that are just not as productive as the top. In fact, there was an example where they were giving law students the ability to use ChatGPT, and the top students actually performed worse than they did before. Okay? Now, can we draw a contrast between these facts and what happened in the past? So in the same paper, we're doing the same exercise, and now we're linking these exposures to individual wage earnings from tax data. So then we can see the same person over time, and then we can see how their earnings change in response to their exposure to automation or complementary technologies. So our finding was that automation has a uniformly negative effect on all worker earnings, regardless of characteristics, whereas exposure to complementary technology actually had a small negative effect, but there was a lot of heterogeneity. So for example, this is how this varies across different types of jobs. So you'll see that automation affected both jobs in manual as well as cognitive, both blue and white collar workers. Fortunately for business schools, jobs that emphasize interpersonal skills, soft skills, have basically no exposure to technology. Okay, the wages were unaffected. Here's how these things vary across worker age. So automation, again, has a negative effect on worker earnings that's uniform across age, more or less. However, labor complementing or labor augmenting technologies actually ended up lowering the earnings of older workers. Okay, so that's consistent with leveling the playing field or shrinking differentials within a job. And the same is true if you actually sort workers on their earnings, and you can net out whatever observables you want. You can net out age, you can net out industry, occupation. So within the same job, workers that were paid more actually experienced larger earnings declines in response to labor augmenting technologies. Now, how do you make sense between these results and the aggregate results that I talked about, where you actually see wages of the occupation rise? Well, you can think about the difference between incumbent workers and new hires. Okay, so my summary so far is that at least based on the experience from past technologies, I think that AI is going to increase differentials across occupations. So a lot of the low-wage occupations are going to be automated by AI, so that these guys will see their wages fall. And it's going to increase pay for occupations that use AI as a complement. And within a job, we're going to see a reduction in wage earnings, a compression in pay, and it's going to displace more experienced workers in favor of younger workers. How am I doing on time? What time?
I think that's perfect.
I need more, sorry. Can I have 2 more minutes?
Take
Yes,
one,
okay,
take one.
Very good. All right. So then we took this as a chance to play with the data and make some predictions. So we used the model that we have and then the data that we have, and we try to make predictions for specific occupations. So here they are. So the occupations at the top are the jobs in finance jobs, since it's a future of AI in finance. These are the jobs that are going to see increases in pay overall. And the occupations at the bottom are going to be jobs that are going to experience decreases in pay and decreases in labor demand. The panel on the right, you'll see the impact on incumbent workers, and you'll see there's a significant displacement effect. You can say, well, is it possible that finance workers get displaced? And the answer is yes. This is what happened in the past. So this is based on a different work with Effie, Vladimir, Anastasia, and Alex. And what we find is that in banks, older workers, actually without modern skills, experience declines in seniority or worse career progressions when firms were hiring a lot of tech workers. Okay, so Steve is going to kick me out, so I'm going to stop. So ready to take questions.
So let me ask one question. What would you have found with Excel? Because I can remember when Excel came in. You can't. I
can, actually.
Oh,
I'm older than I look.
Sorry. So what would you have found?
About what? When
With Excel,
AI gets introduced?
No, Excel. So
Yes.
Excel came in
Right.
in the early 80s, and I think there was a lot of worry, particularly on the finance side, that it would eliminate a lot of jobs because it could do stuff that you used to have to do by hand. And what it appears to have done, it increased jobs, particularly at the higher end. It actually increased pay differentials rather than reducing them.
I mean, yes and no. So I think, look, some tasks got automated. So you want to think before Excel, you want to think calculators. Calculators actually used to be a job. There was a person whose job was to calculate, or rather compute. Okay, that's where computer comes from. So these jobs got eliminated when computers came about. And then you had new tasks being created. So there's this interplay between old tasks being automated and then new tasks also being created. Now, with Excel, presumably there was someone that was super good at using Lotus 1, 2, 3, that it took them a while to get used to Excel. So for that person, there's a bit of a skill displacement. I think when you make a tool that increases everyone's productivity, actually I think that's going to shrink skill differentials, not increase them.
So let me not just say Excel 1, 2, 3, Excel, it's all the same thing. Spreadsheets actually increased jobs in finance and increased pay differentials.
I agree, because they created new tasks. They created new jobs that they expanded the set of possibilities of what could be done.
So that's not going to happen with AI? Because you're
It could,
saying
absolutely.
I thought you said the skill differentials are going to decrease.
Sorry, to be clear, I meant the skill differentials within a task. So it's absolutely true that AI can create new tasks, and then it's all fair game. But for the existing tasks that we have, I think that's going to shrink skill differentials, or rather shrink pay.
So let me ask one more, and then I'll stop. So do you and Andrea should weigh in on this, agree or disagree? Because Andrea said it's a more superstar kind of world, And I interpreted what you said as a less superstar kind of world. So is that right? And what's going on?
That's what I think.
So I guess I need the microphone.
There it is.
All right. Yeah. So we have to nail down the sense in which we agree or disagree, which will be a very fun conversation for those of you who don't know. Dimitris and I are co-authors and current work together and have a very long history of heated and not heated. We agree and disagree. So let me say the sense in which there are some subtleties in the differences in what we're talking about. One is when Dimitris is talking about complementary or substitutes, he's using ChatGPT as the RA to decide whether a human is needed or not. I thought that was a great idea too, until Gregor convinced me that it wasn't such a great idea, in the sense that if you asked your RA, is the human needed or not, you might get 5 different answers. But ONET actually takes this core versus supplement tasks and tells us whether the task is core or supplement, so we can see whether, if the tasks are more supplementary, maybe ChatGPT and generative AI generally, be careful that we're not talking about ChatGPT specifically, but generative AI, meaning you can interact with ML, NLP, these tools we've had for a long time, just in a very broader way. So there's a difference in the way we're measuring things. I also wonder if there's a little bit of, occupation versus role. So I think the superstar effect is that, it's really about the people at the top roles within an organization are kind of the ones that are going to really benefit. So there's also that kind of hierarchy difference. But I do think that we disagree. I do think that there will be an active debate about whether this is going to be generating more inequality or less. My view at this point is that it will create more inequality within occupations.
I think the difference is whether we're thinking about between tasks or within tasks. So I think between tasks, it's all fair game. But I think within a specifically narrowly defined task, I think it's going to decrease skill differentials because it's going to displace people that are previously skilled at doing this very well.
So I was just going to jump in. I tend to think of the superstar theory as well as a way to think about this. But when you think about tasks, I think about it more from what's a rare skill and what's a common skill, right? So if you think of ideas as a rare skill, right? So you have a task where the idea is really important, creativity. Large language models, generative AI, they can enhance that, but it's hard to replace that, right? So
Absolutely.
I think you're going to see much bigger inequality there, right? You're going to leverage the ideas. I think it's true that, to Andrea's point about the role at the top, it's typically the people that have that skill, or they wouldn't be there. So I think it depends.
Absolutely.
It's not obvious to me.
I agree with you. By the way, I wasn't just thinking about generative AI. So I think all I'm saying is, if you increase the quantity of skill, the price of skill tends to go down.
Well, but I do think that, but I think there are complementaries that go the other way, and they're big at the top, and I think they're big on
Right, but I'm saying
this
if
can't
AI
help
can
with.
generate ideas, the value of ideas is going to fall.
That's much,
Yeah, that's all I'm saying.
Can I ask a follow-up question to what Dimitris said? So Dimitri uses the standard methodology in labor economics, which is if there is new technology, let's have some kind of measure of exposure to that technology and see if that measure kind of works and associate it with changes in employment or whatever. But what that methodology misses is the new task, which, as Dimitri pointed out, being created. Like a very good example of where, 5-7 years ago, labor economists were in complete agreement that areas like HR are going to be completely replaced by AI-powered NLP solutions. That was a consensus. Now, that did not happen. So what happened actually is, me talking to a bunch of VCs who invest in these HR-focused companies, was HR professionals, instead of now sifting through, reading through a bunch of resumes, doing all of this, repetitive menial type of tasks, that gets replaced, and instead what they can spend their time on a higher level type of task, which is culture building, retention and employee satisfaction and engagement. So, that's one example where ex ante, because a lot of what they've done at the time could have been replaced by AI, and some of that did, but that freed their time to do new tasks they didn't have time before. So how do you think that missing from your analysis can affect kind of interpretations of your findings?
Yeah, absolutely. I think it's hard to predict which new task will be created. Everything I was saying was conditioning of the same set of tasks, so the actual structure of the job's not changing. So that's why I was framing my analysis about the medium run.
Okay, so I was a product manager before getting into academia. So we had a list of product features we wanted to enhance, a software company, and if ChatGPT were to come today, there are two choices I can make. Either I get rid of a few programmers, or I go down the list of features that I could not put in my program because they are now 50% more productive. So how do you think that will play out, that instead of getting rid of people, you probably increase the product, enhance your products?
So I'm not sure I followed you. Can you clarify your question? You're asking in a product design whether we think it's going to be a complement or a substitute, or?
No, I'm saying you have, as a product manager, you can improve product, right? So can you, with the same people, you can improve product now that this new technology. So it's not about replacing task or new task. It's the same task, but now your output is increasing, basically.
It's sort of what people did with Excel, right? You couldn't do much with a model beforehand. Once you had that capability, you could do a lot more for the same job.
That's fine. That's okay. But I think what you just mentioned about designing yes. So I think I get what you mean. That's why I said originally a lot of this discussion, what I was focusing on was partial equilibrium effects. There is a general equilibrium effects where it's just going to increase demand for stuff overall, so then everyone's going to benefit. So there's a sense of tide lifting all boats. So I didn't have time to talk about that, so I left that aside. So everything that I said, you should think about as relative statements, not level statements. So there is a view that everything is going to be more productive. We're going to produce more stuff. There's going to be more demand for everything, and that's going to have a level effect on everyone. So I was abstracting from that.
Okay, I think we're going to stop there. We'll get you for the next set of questions. So thank you, Dimitris. And now we're going to move to from labor to more asset pricing with Toby Moskowitz and then Lauren Cohen. And let me get to Toby, which will be... Okay, get rid of that. There's Toby.
All right, thanks. Thanks, everyone. Thanks, Steve. So I'm going to talk a little bit about asset management and investing, and just want to lay some of the groundwork here of where the opportunities are, where some of the challenges are, some of the pitfalls. I'm going to start with just data. I think we've already touched upon this, particularly in Andrea's work, where if you don't have data, right, this isn't going to be very, very useful. I think one of the things in the asset management industry that people have been intrigued by in the use of these technologies is there's a ton of data out there that we've only recently been able to capture. I'd say that's in the last decade. But it's just an example. Some of you have seen this chart. This is from Domo. This is the amount of data that's created every minute of 2022, and they update it every year. You see things like, 500,000 sales on Amazon every minute, millions of tweets, just an insane amount of data, most of which, though, is unstructured, right? So this is audio, video, text files. And where I think this technology has been, or may potentially be useful, is in providing some way to aggregate that not unstructured data and put it to use in a quantitative way that helps us make better decisions, right? Typically, those decisions are predictive, but they don't have to be. We've talked about prediction a lot today. It's also useful to understand what's going on as well, and I'll touch on that a little bit later. But for the most part, it's really been a lot of the techniques in machine learning were invented decades ago, right? But they weren't that useful because of computing power and also the lack of data, which is now being ever more captured. As we've touched upon, some of this data is captured internal to firms, and they keep it proprietary. Some of it is external, and we're struggling with how we put that all together. So let me start with, there's a big data opportunity, right? And what we do with it is really part of the question. Now, if I think about asset management specifically, asset pricing and predicting asset pricing, most applications, or at least the ones that are most talked about, are about predicting prices, finding alpha, okay? Now, in order to do that, you've got to quantify this new data, this unstructured data. We've made some progress as a field in natural language processing and large language models. Audio, not much. Video, haven't even really touched yet, but it's all out there. And I think the idea that most people talk about is you find new signals, you look for hidden interactions between variables we already thought were there, you look for nonlinearities in the data, things that we typically don't model because our models are simple and the machine can search over thousands or more than that, hundreds of thousands of different types of models to find the best predictive combination of these things in the data and provide predictions for prices, okay, to find alpha. But remember, finance, particularly capital markets, it's different than the typical applications of AI. Where have been the big breakthroughs for AI? It's been where the signal to noise is extremely high, right? Imagine the self-driving car, right? Not only can it generate, does it have a ton of data, and the task is well defined, it's static, right? You just have to navigate a certain route, and there's a set of rules. It can learn very fast. But if I want new data for an out-of-sample test, I just put that car on the road for a couple of hours, and I've got a few more billion data points. We don't get to do that in financial markets, right? We have what we call a small data problem, particularly in asset pricing. The left-hand side variable, right, which is prices or macroeconomic events, it's finite and it's small, and we don't get to rerun that experiment. It's also dynamic, right? Things change, markets evolve. There's an equilibrium concept where things are going to evolve. And part of that is that it's a highly competitive environment. So when we think about alpha signal generation, right, now it's non-stationary, it's evolving, it's dynamic, and it's going to be fleeting, okay? Competition and equilibrium dictate that we will always be in a very small signal-to-noise environment, okay? And we can have a debate as to whether we think this technology is going to make the signal noise even smaller, or I should say faster, and I think there's lots of good arguments to suggest that will be the case, and even some anecdotes that I've seen in my time in the industry. But this is the problem that we're faced with. So given that problem, where is the best use of AI and technology in the asset management industry? I would argue it's probably not in alpha generation. It's fun to talk about, but it's going to be tough to do. Okay? That doesn't mean you shouldn't try. But market efficiency is going to reinforce this concept, and AI and technology is going to make that problem, I think, even difficult, although that's certainly a debate that one could have. So how do you navigate that? Well, I think the importance of structure and priors theory is going to be helpful here. So a lot of people think that with AI and technology, we talk about let's say economists and where our jobs will be. People often think, well, theorists won't be as valuable. I actually think they might be more valuable because you're going to have to navigate and put some structure on the data. You don't need a consumer-based theory if you work at Amazon to figure out what people like. It's very easy to do. It's stable. There's a ton of data. We don't need models as much for that. In our world, we do. And so there's a couple reasons. One is you obviously have overfitting concerns. In a low signal-to-noise environment, you worry the machine's going to find errors rather than signal. Okay? You also care a bit about interpretation because ultimately what you're interested in is forecasting, and forecasting, particularly in a dynamic environment, becomes very, very challenging. And you want usefulness for decision making, right? Ultimately, you're making investment decisions or asset allocation decisions. You need informed decision-making. The machine can't do that for you, and this is where the human element comes in. And one of my favorite examples of this was a colleague of mine was on the road traveling and saw the use of a new AI technology. This is in a sports context, not in asset management, and captured this screenshot, which I thought was pretty awesome. They were using keys to the game for a baseball game, Colorado Rockies against the San Diego Padres. And this is what the new technology at Fox Sports came up with, which is keys to the game are to score more than the Rockies. This is from the Padres' perspective. And just in case you're sure, they want to convince you that that will work, the Padres were undefeated, 12-0, when they outscored their opponents. Okay? So the machine's not wrong. It's just not very helpful, right? It's not very useful to make a decision. So I think we have to think about structure. We have to think about priors. And that's critically important to using this technology in any realm, but I'm focused here particularly on asset management, which I think is where it's most useful. So where else could it be useful, right? Alpha is going to be challenging. Finding new signals is going to be challenging. We're still going to do it, but there's lots of other things that you can do. One of the applications that I think is interesting, and I think these are all research opportunities as well, is thinking about how to denoise data. We might have a good idea of how to measure a certain concept in financial markets, say it's value investing or some measure of cheapness relative to some fundamental. We know there's noise inherent in any of these measures. Using these kinds of techniques to denoise, now we have to define what noise is, so that requires structure, that requires modeling, that requires interpretation and theory, but thinking about denoising as opposed, so enhancing signals we already have or making them more precise rather than finding new ones can be valuable. I think robust measurement is another place where this technology can be helpful, right? Understanding that nothing we measure is perfectly precise and that we need to think about different techniques. One of the uses that I see in asset management for machine learning is you're not just thinking of a model, but thousands of models that are all related and all have some truth to them, and you're smoothing over all of these models to get at something that is going to be more robust out of sample. Remember, ultimately what we're trying to do, at least in this context, is predict. You want a robust prediction, one that's less sensitive to fitting errors, to noise, to all kinds of other impediments that can lower predictability. This can also help model building. So not only do we need structure and theory, right, to help us navigate the data, that data simultaneously informs us about the theory, right? Where the theory might be wrong, where we might be able to measure it a bit better. And so this is a constant back and forth. We've done this before, right, with other technologies. This is just the latest one, okay? And where I think some interesting applications can be, I think far more interesting in some cases than the search for alpha and signal, is thinking about other aspects of the asset management industry that are also really important. They're not as fun to talk about, but they matter to the bottom line. Think about risk management, right? Risk is something that, or at least if you just think of a very simple concept of risk like volatility, it's already inherently more predictable, right? We can predict second moments better than we can first moments for sure. But risk is also dynamic. It's challenging, and there's a lot of interesting issues. It's also it's harder to see. The interactions there among firms, among investment vehicles are also not easy to think about and to organize in your head. So I think there are risk management applications that people have barely begun to do. You're going to start to see, I think, people developing their own risk models with this technology or challenging existing risk models. I think of trading as another aspect. So Dimitris had some slides up there about, you can put bid and offers out there automatically. You can if you're just willing to take prices as given. If you want to trade and improve trading processes and understand what affects those, learning from trading models can also be particularly powerful. And it's still not a lot of data, but in the high frequency world, it's a little more data than we typically have from just looking at prices, because there's also flow information, there's a whole order book as well. So I think that's an area too where this technology might be helpful in learning about. One of the hardest things to do in practice is understand what your trading costs really are. You typically don't know until you actually do it, right? So to the extent you can gather this data to learn from it and provide prediction in that context, I think that could be useful as well. And then putting this all together, you can think of this as portfolio design or implementation, combining all these things, how they all fit together. That's a very complicated problem. One that, and again, you're talking about a forecast for the future, a prediction, one that I think requires merging lots of different models with lots of different structure from different aspects of the portfolio: price prediction, risk control, trading, merging that together, this I think is a promising area of work, and I don't think people have solved this or even begun to really solve this problem at all. And I think it's a tough one, but one where these technologies might be helpful in arriving at a better way to implement and design portfolios. Okay. And then we got the question of markets that don't typically have a lot of data. And this one's a question mark for me. When you think about private markets, non-publicly traded markets, where you don't have prices and you don't have good measures of all the things we care about, variances and covariances or even really good accounting information, what else can you look to, right? Well, again, by capturing a lot of this unstructured data, and I know there's a few firms that Steve's probably knows of them better than I do, that use this kind of technology to capture things like consumer demand and other signals that help predict what the cash flows might look like for these private firms. This is an area where there's a need for a lot of data, and in fact, harnessing this unstructured data might be the only place you get to look because you don't have these other publicly available type data sets. I think that's actually a really interesting area as well. I think the difficulty is where do you find a place where everyone's willing to share that data that we can learn a lot from? Everybody's going to keep it to themselves. But I know of at least one firm that's trying to put some of that together for very, very small private companies in the retail sector, trying to do something along those lines, which I think is an interesting opportunity. And then just to summarize all this, the way I think about, at least for the asset management space, I think of this technology as evolution. It's revolutionary data, but these are evolutionary ideas. The new technology and new data bring us opportunities, and we now have better tools, but they're never going to replace science, right? And a big part of that, I think, is it's going to enhance what we already do and the importance of structure and thinking about where this can be valuable and where it's going to be hard. Like, for instance, it's not all about alpha. I think that's where the asset management industry, at least that's where I think it should go, and we'll see where it goes. I'm going to stop there. I think we're just about on time, and I'm happy to take questions.
So I couldn't tell, will this transform investment strategies and fund management, or just a little bit of a change?
Yeah, I mean, I don't know for sure. I would say, I don't think it's going to, I would say it's not going to transform it. I think of this as an evolution. I think it will change it around the edges. I think what you'll see is what I'm trying to see, or what I'm seeing in my work with AQR is it's entering a little bit of almost everything that we do, but it's certainly not taking over everything we do. It's like any tool. It can enhance what we're already doing, make it a bit better, but I don't think it's going to replace fundamentally what we do. But we'll see over time.
I have a question as well. Assuming uniform adoption, do you think it's going to increase or decrease the performance across funds?
Well, it's a zero-sum game, right? So I think what you're going to find is it's going to so what I think will happen is it will reallocate alpha. So firms that are, in fact, Ken French and I were having this discussion right before this. So, and I think you would agree with this, which is what you're going to find is it's not going to generate more alpha. I think the information is what it is, but some will be able to get access to it faster than others, deploy it faster than others. So you'll see a reallocation of that, but eventually, if everybody's doing the same thing, it has to be competed away. And we've seen some examples of that. I mean, famously, 7 or 8 years ago, people were all excited about this satellite data that came out. Ex-NASA engineers were selling to hedge funds. I can tell you personally that in the process of testing a random sample of that, where we had a 6-month period, after 3 months it died. The signal just was gone, everybody had it. So it's pretty easy to see the stuff get competed away.
So that says markets will be more efficient, but does it say anything about volatility?
So that's an interesting question. I mean, I think markets potentially become more efficient with this. It's not obvious. You could make an argument the other side. I have a hard time predicting whether it's going to make markets more or less volatile. I mean, in one sense, if you think they're more efficient, I suppose you'd think that you would get less excess volatility, right? But in the process of getting there, I'm not sure. You have to buttress that with the fact that this technology not only leads to, say quantitative hedge funds using this to extract or to price information in markets, but also it allows uninformed investors to access those markets faster too. And I'm not sure how that dynamic plays out.
Very quick question.
Let's go to Tania first.
Piggybacking on Steve's question about risk implications. Have you guys thought about real effects that's going to propagate in firms? For example, in a very new paper with co-authors, we found that firms that use AI increase the systematic risk, which we're still trying to figure out like what's happening. Have you thought about like propagation into real economy of using this big data for trading?
I haven't really thought about propagating in the real economy, although I would say a step toward that would be what I think you find with the new data and new technologies to access it is there are links between companies that we don't typically measure, right? So for example, we typically think of industries as a product market concept, but there are lots of industries that are connected through the labor market. In fact, you can see from some of the data today through patents, through news, through all kinds of different things. And when you think about how risk or shocks affect those companies, I think it goes through many, many channels. You can't think of those channels through your head. There's too many of them, right? So as an example, I have a paper right now I'm working on with a former student where we have 18 different ways of connecting firms. And that actually turns out to be a better way at predicting correlation changes in the market rather than trying to do it statistically, right? So one step towards we haven't taken that next step, which is now let's think about how actual shocks propagate to the real economy. But I think a first step would be to understand what does that network system look like? I think there's work out there both in practice and academia that's starting to look at that. That's one area that I think is interesting, and I think there's a lot more to do. So.
Thank you. Actually, when we are looking at what's happening now in the industry in terms of the job that we are asking from the quants, what we see is with some people, with absolutely no, financial education, they are only asked to maximize the P&L. So, and I have an exchange with a quant who is doing asset pricing, and he didn't even know the formula of Black-Scholes. So I was wondering, really, we need now, the theories and models when you just, with the data, you just making the input to the system and model, reinforcement learning makes, the pricing for you. Sometimes even better, that they say, Black-Scholes. This is just, I was wondering, whether we need, we are going to have more models or we are going to give up, the models and theories and what we have developed recently.
I'm very happy if everybody else but us gives up models, because I'll take that advantage every day. Look, I think we're in a very low signal to noise environment. If you don't put structure on this, I think you're not going to make very good decisions. I think that's the bottom line. So, if you don't know Black-Scholes, nothing against Black-Scholes, but if you don't know models, I think enter at your peril. I just don't see it working.
I'd like you to address the last question that was raised originally. What are the regulatory implications, both for regulators as well as the regulated?
Yeah, no, look, regulation, I think nobody knows what to do with it so far. So I can tell you from personal experience, we've talked about firms don't want to release their data to ChatGPT or other large language models because it's proprietary. There's also a regulatory concern, which is, let's suppose I'm a financial advisor or a fund manager. If my decision on your portfolio isn't necessarily coming from me, but from ChatGPT, there's an issue there. The SEC may take issue with that. I think they don't know what to do with it at this point, right? Because you're paying me a fee to give you my advice, but if my advice isn't really my advice, it's everybody else's from this, there's an issue there. So I think, I think they're struggling with this, and I don't have the right answer for sure. I think there's going to be a lot of debate about what the right thing to do is. What I can tell you what we do, from a quantitative investment manager, one of the things that we like to do is, forgetting about the regulatory piece for a second, although that's certainly a constraint because we're prevented from using this stuff. One of the reasons we create things in-house is also because we want to, you take ChatGPT, for instance. It's not that valuable from an investment standpoint on its own, but there are parts of it before that gets you to the end outcome. Because remember, it's designed to interact as if it's a human, as if it's thinking. But there's parts of it where if you were able to interrupt that process, that can be very valuable for quantifying data. So we build that ourselves, right? We build something that would look like it's a large language model, but it's not designed to produce an interface that allows you to converse with it. It's designed to quantify data that we had no idea how to quantify 5 years ago, right? So I think that may get regulated too, but at least that's more in-house. You would say that that's our own expertise, but I think the regulatory issues are interesting and not understood well yet.
Okay, perfect. Okay, and last but not least, Lauren Cohen. So let's see, there you are. Voila.
Fantastic. All right, thanks so much. And so, look, the panel's been fantastic up to this point. And what I'm going to do in the time that I have is I want to focus a little bit on where the rubber has met the road when it comes to applications of kind of AI and up through today within the financial industry. Look, one of our main tasks, right, as social scientists is describing like that. There's no window here, unfortunately, but like describing that. Go to a direction, describing the outside world, and so how it's kind of zigged and zagged and the use of this up to now. And so I'm going to focus on that. And as a kind of founding of that, look, we first need to take into account randomness, right? I mean, essentially, what these AI and ML frameworks are doing up through ChatGPT is they're searches or they're predicting, but they're pattern recognizers. And this is something that it turns out that humans have wanted to do since birth, right? Like babies figure out what to do when they want to get something, when they want to get food, or they want to rest. And we have done this since literally the beginning of time, right? We've tried to burn crops because we thought that would get us rain. Like we've done some things right and some things wrong, but we've wanted to get a handle on this cause and effect. And the problem is that the brain is so good at this that it oftentimes overinterprets and overfits data. It overfits these patterns. And much like Toby just talked about, this gets to be a larger and larger problem as the dimensionality and just amount of data increases, certainly relative to this noise. And so this idea of randomness is one that has popped up again and again in the application of AI, and I'm going to show you a couple places where it has and how it's kind of been dealt with in an all right way and how it's been dealt with in a total train wreck way and what we've seen happen. And so it's this kind of natural inclination of all human brains that we want to say, look, if I could just get enough variables, right? We have hundreds of billions of parameters that are now being estimated in 2024 by GPT-4. And we say, God, if we could get to trillions, we get to hundreds of trillions, right? If we could get to, you know, everything past that, add more zeros, and we'll get there. But the problem is, and investors' brains want to think the same way, that belittles the role of randomness. It belittles the role of randomness. And randomness is sometimes a large or the largest explainers of a lot of the things that we see in asset markets. So if I were to give you a one-factor model, right, you could have one factor explaining asset markets, and it turns out, this turns out to be kind of systematically true across asset markets. We can think about equities, bonds, the real estate. Over the past 10 years, the single factor that you would want that explained the most variance is the health pandemic that we've had. But of course, there's not a single AI model in the world that using data up through 2019, hell, you can give it all of the New York Times, all of the Financial Times, you can give it whatever it wants. It would not have predicted in 2019 that a health pandemic was going to happen in 2020. It just wouldn't have, right? It's that element of an innovation in what's happening that drives asset markets. And we see that with what happens when presidents and prime ministers speak, or when hurricanes or when tsunamis happen. Those drive a large amount of variation, and that is by definition random, and our pattern recognizer is not going to be able to fit that. So let me give you one example. So this is now harking back to Twitter in the stock market. So it turns out a computer scientist, Johan Bolin, came out with this paper, and it kind of hit with a splash in financial markets. And I'll tell you what happened. Came out with this paper that said, hey, look, using Twitter sentiment, we can predict the next day's returns. Okay, so we can predict S&P and whether it's going to go up or down in particular. And in fact, we can predict it with, this is super hard to read, but we can predict it with 89.4% accuracy, right? If we use last 1, 4, 6, and 7 day sentiment, we can predict it with 89% accuracy. Okay, that's your first red flag, that he's used 1, 4, 6, and 7. But look, this was coming from a very computer science standpoint, right? Like there are journals in computer science, and it warms my heart, that are called journals of data mining, right? Like the whole point is to fit the system super well. And so like that's what he's tried to do, fit this with a lot of internal validity. And so I invited Johan, I ran an MBR at Stanford, and I invited Johan to come present, and he did. And I got to talk to him about this. So it turns out this is what happened. This came out, and much like Toby mentioned, look, hedge funds aren't sitting on their hands here, right? They came to him, and in particular, this hedge fund that was London-based called Derwent Capital came and said, we want to put money behind this. Because if you can predict the market with 89% accuracy, right? You're not a billionaire. You're like a trillionaire. You can buy small planets, right? Like if you can really predict the most liquid markets this way. So they went all in on this. They said, hey, we're going to put a couple $100 million behind this. We're all going to get rich. We're going to generate more money than anyone will ever need. So what happened? Well, the first month that this came out, and I remember this very well, they beat the S&P. Okay, and so there were these headlines that came out that said, hey, hedge fund managers, polish your CVs, buddies. Like, it's done, okay? Because we now have this great technology using sentiment and all this AI. That was the first and the last article that was ever published on Derwent Capital and Strategy. And why? Because it completely toppled. So I asked Johan about this. This was actually in October after this happened. I said, Johan, what happened? And of course, his explanation was, oh, yeah. They took my signal, but they used it the wrong way, and I'm going to show them, and I'm going to show the world, and I'm going to come out with it on my own. Unfortunately, I've never heard from Johan again, but the point is, this is something that it can randomly beat for a little while, but it's something very hard to do. So let's look at another example, okay? Wealthfront and betterment. So this is thinking more broadly about asset management. The same thing happened when we got this robo-advisor kind of this really flourishing. And so I have students that went on to kind of go and work and help found some of the things at Wealthfront Betterment, and I can tell you when they first came out, they were going to revolutionize the industry, right? And essentially, they started to take a huge amount of capital and really strike fear in the hearts of traditional financial advisors and RIAs, right? And they did get a lot of capital from the beginning, right? If you could see their growth path, it looked like that exponential curve, and it looked like they were going to take over everything. Right? Here's the problem. What happened with that growth curve is it completely asymptoted. So it turns out that many of these large companies did try to introduce their own robo-advisors, and what they found is the same thing that Wealthfront and Betterment found. It's that it turns out some people want to have their money with you, but not that much. When it gets to be big stakes, people want to look across the desk at whoever's managing their money and say, okay, Susan, I've been with you for 30 years, you've been tracking, you know my kids, you know what I need, I trust you to figure out what to do next. And so it turns out they were never able to break in to the billions, tens of billions, hundreds of billions of dollars, and even when they got most of the capital, it was from like tech millionaires and starting to be billionaires. Even when they amassed enough capital, they pulled it out of Wealthfront and Betterment, and they went to traditional wealth advising, okay? Even they kind of didn't have that trust piece. So that turned out to be such an important piece that AI was not able to displace. Okay, and up to this day, it hasn't been. So I'm writing a case on Edward Jones right now, and they're putting AI in. So the issue that they have with AI is that, of course, their advisors right now are worried it's going to displace them. And so Edward Jones first had to convince all the advisors, no, this is going to be a complementary tool and not a substitute, so we'll use it that way. And secondly, never tell the individuals that you're using it. So to Toby's point, they say, keep it on your computer, but keep that pointed toward the back and keep our model there. And so whether these individuals now know it or not, they're getting AI, they're getting robo-advising, but they're getting it through Susan, right? They're getting it through the person that they can trust. And so they're building this trust. Now, what I think is a really fascinating and an open question is where within the financial industry this trust is an important piece and where it isn't. So I'll give you the opposite case to these robo-advisors, and that is InsurTech. So InsurTech, if you think about some of these new entrants in InsurTech, these are Lemonade, Ladder, some of these names you might be familiar with, and essentially they've burst onto the scene and they've amassed a huge amount of the volume and a huge amount of policies and policyholders to the tune that existing incumbents are really now worried. Here's the problem. With InsurTech that they're implementing, it's great because they actually have to list their loss ratios and everything else that they're doing. So they claim to be using all these new tech and these new AI models to do better underwriting, and it's completely false. Their loss ratios are actually higher than Prudential and MetLife and these other places. So their InsurTech is, when they apply the tech, it's on the UI and UX. Because it turns out, in the same way that we love sitting across from someone and trusting someone with our financial portfolios, the single thing we hate the most in insurance is other people. And so when we crash into somebody else or have something, we just want to take a picture of it and send it out. We don't want to wait till somebody comes out and does a claim and then argues with us. And so it's that same piece, that trust, we actually don't want. We don't want that human interaction piece. And that's allowed InsurTech to flourish with these same kinds of tools, although not on the application side of the loss ratios or calculating kind of these types of metrics yet. I want to turn to another, and that's real estate tech. So Andrea mentioned this real estate and property, and it turns out one of the big kind of well-known firms, they ventured in with AI, and they jumped both feet first, and this was Zillow. So Zillow started this, it's called iBuying, essentially using this automated buying. Opendoor was actually the one who started this, but Zillow jumped after them, and Zillow went in with everything, okay? It hired hundreds of PhDs, it invested billions of dollars and said, yeah, this is the future of Zillow. Now, this was met in markets with outrage by people, right? With prices going up, everyone said, gosh, Zillow knows more about markets than anyone, and anyone possibly could. They have better data. They're going to be able to outbid us. They're going to be able to buy, sell, and flip much better than us. It's going to drive up prices. It's going to be this terrible selection problem, and so we're totally screwed. And so what ended up happening is that someone did get totally screwed, but it was Zillow, okay? And why? Well, it turns out they went with their model, which I assume was a quite good model, at least was a quite developed model, but they did the following. They said, okay, we're going to do this. We're going to go out for every house that we think is worth 75, right? And we are going to bid 50 for it. Okay? So we're going to bid 50. We think it's worth 75. That's awesome, because now we have this like huge leeway. And so even if we're a little bit off, even if it's worth 70, we're still going to make a ton of money. Okay? So they went out and bid for all these houses that they thought were worth 75. They bid 50. This is what happened. Everybody who knew their house was worth 75, of course, you think they're going to sell for 50? Absolutely not. Everybody whose house looked like it was worth 75, but it was really worth 25, happily sold to Zillow for 50, because they're like, oh my God, well, that was only worth 25. You could have it, right? And so Zillow ended up buying all the crappiest houses that didn't fit their model because their model couldn't perfectly fit this data. So this asymmetric information, this lemons problem, took down Zillow. And in fact, it took them down to such an extent, they lost hundreds of millions of dollars, had to cut 25% of their workforce. 1 in every 4 workers they had to fire, and they abandoned this model. Okay? You can't out AI basic economics. You can't out AI a lemons problem, right? And Zillow, this incredibly profitable and we think sophisticated firm, had to learn that the hard way. Okay? So let me kind of end by taking to this frontier of ChatGPT that we seem to be talking about, and these kind of generative pre-trained transformer models. And so we've already talked about kind of a lot, the kind of base of these. These are just solving this search problem using these hundreds of billions of parameters in the background and data to estimate. Now, they've had some successes to date, right? Dating back to, I think, one of the most well-known, which is when Google had an AI engine that beat a top player in this game of Go. Right? And this was kind of a big landmark in AI's move in this direction. Now, from there, we've also started to apply it within medicine. So it turns out AI performs incredibly well when reading mammograms, right? And so you can think about this in radiology. We found some positive aspects of it. We've also found some positive aspects in its answering of doctors' medical questions. So it turns out they ran this study where they had doctors actually ask it a question and then rate this kind of GPT's responses. And it rated a 5.5, which was between correct and completely correct. Okay? I've never scored that high on anything. Some were incorrect and completely correct, but they were getting it this right on these doctors' tricky questions. And not only that, but it even is helpful for softer skills. So they're even starting to apply it in therapy. Okay, so these are in, think like talk therapy, psychotherapy, that ChatGPT is answering questions about these very kind of sensitive emotional issues in mostly correct ways, so showing promise. So given this, it seems like investing's got to be easy, right? It's literally, we could trust our lives with it. We could certainly trust our portfolios. And of course, the answer is no. Right? And so they've tried to implement this. So this was an example where they tried to use AI to to kind of generate an investment portfolio. And much like the Twitter example, they outperformed in the first month and then ended up severely underperforming thereafter. Okay? So bottom line takeaways. Okay? So this is going to keep happening, right? We're going to keep pushing forward. That's the beautiful part of innovation and human innovation. We're going to keep pushing this frontier forward. And as we do, we're going to keep having innovations along not only the data processing side and the data analysis side, but also the data generation side and how we even think and what we think of as data. Okay? There have been successes within this space, things like OCR, like we've talked about, or KYC, or other aspects of UI and UX that have done incredibly well. In thinking about the investing, it's harder to find systematic examples where those have succeeded. And so I'll leave you with this anecdote. I had the person who ran Goldman, so AI and machine learning, this has been implemented at many of these big banks for now decades, right? So he actually joined in 2001 and was there to build up their machine learning and AI systems to try and predict they were trying to predict time series variation in asset markets returns, right across commodities, equities. Talked to him in 2017, he was quitting the firm. He said, Lauren, I've been banging my head for 16 years hiring PhDs in physics, in math, in finance, and economics, and you just can't do it. And so what did he do? He quit Goldman, and he, ironically enough, took a job at Google, okay? So he's betting on the other side. And so, look, here's what I want to leave you with, okay? If there's one piece of advice I can give, it's to respect randomness, right? This is true both within finance academia and within the application on the practice side, which is there are parts of processes that are random, and oftentimes they're most of the process. And yet, we are getting some promise within this space that if we focus on the aspects that aren't random, if we can say, yeah, 85% is random, so let me try instead to model the aspects that aren't random, then that is where the promise lies. I'll give you one example. I had a colleague who just published a paper that found that CEOs, okay, this is human behavior, in earnings calls, right, so this repeated behavior, they called on people with a first name as themselves significantly more often and gave them more information. So if the CEO's name was Steve and the person's name was Steve, he called on Steve the analyst more often and gave them more information. And so, like these kinds of behaviors, these repeated behaviors that have value implications, they, I think, are great places to start. And with that, thank you very much, everyone. I look forward to the Q&A.
So I have a question for you, Lauren. I think I agree with you. There are some tasks that AI cannot do as well as humans. I think soft skills is a good example. Like AI is going to replace doctors, not nurses. Now, with that view, how do you think we should change what we teach students in a business school? Should we change the mix between quantitatives and soft skills?
Yeah,
I think that's a question for the whole panel.
Yes, so I'll take the first step, but then I would love for you guys as well, given that it's the future of our jobs' sake. I think we absolutely, and so, and I'm trying to do this, but I want to hear your takes too, that students need to understand and they need to embrace these tools. Okay, the worst thing we can do is say, yeah, they're going to take care of this in the engineering school, so don't worry about it, right? Just let the engineers do it. And I'll give you an example of Mike at HBS. I'll just name this person Mike. Mike was a professor who was coming in to teach this core finance, first-year finance, and we were teaching Butler lumber, which is this very old case that we teach every year. And so we started our teaching group. We all teach together, talk about what we're going to teach. We're going to say, okay, at this point, we're going to move to the spreadsheets, and we're going to talk about the income statement and balance sheet. And Mike raised his hand. He said, no, I don't do spreadsheets. And we said, well, Mike, you got to do spreadsheets. Even if you don't use them, all our students are using them. They have to understand how to use them, or they can't be investment bankers, and those jobs are going to have. And Mike's like, that's not my way. No, I'm going to do it on the board. And we had to ask Mike to leave the teaching group, and someone else had to come in. So if we don't teach our students this, we don't want our students to be Mike at Goldman Sachs, and then they get pushed out of the firm. Yeah, Toby.
So I'll take a stab at it. First of all, I'm a little scared by the fact that we're going to have academics teach people soft skills. That sounds like a very dangerous thing to do. So I hope that's not the world we're headed to. While I think those soft skills are always important, and business schools have always tried to provide those, I don't know that they're more or less important going forward. I actually disagree that we won't need to teach them quantitative tools. I actually think we might need to teach them more. Like I said, if you just use ChatGPT but don't understand how it works, it's only useful in a very limited way. If you actually understand how you get to that outcome and you want to use it for a different outcome, it's actually very powerful. So I actually think even though students themselves may not be, go back to Steve's Excel point, they may not need to use Excel anymore, right? And they may not be able to use those tools. They still have to understand the basic concepts of how we use this technology to get to the answer. So I actually think, I'm hopeful, and again, I'm biased because it's in my own interest that this is the case, but we actually need to teach more quantitative skills to our business school students, or they're not going to be able to use this technology.
So I guess I'll take a stab too. When I started introspecting about my own kids and my own family and what they would do, I thought, you know, maybe they should be studying philosophy. You know, like, and this kind of harks back to what I think Toby and Lauren both said, that models are actually going to become more important. And anyone who can really create the model, design the model, kind of at the top of that, I think will become very valuable.
And I would add one thing to that. I think what Lauren said about randomness and not understanding randomness, it's a model, right? That's statistics, and that's something that the more they understand that, the better off they're going to be. So I think we, hopefully still have a role.
Absolutely.
Last thing here, I think, talking to data scientists, what's very important is problem-solving skills, and this is what we teach MBAs, right? Companies have problems, and different tools are appropriate for different types of problems. ML stuff is not appropriate for everything. Lauren touched upon this. So I do think that we need to continue to teach our MBA students problem-solving skills. They're the managers. That's what they're supposed to do. But I do agree with Toby that they need to be educated on what are these ML and new tools allow them to do and where they're appropriate to be applied. But they don't need to be sitting down and implementing ML models by themselves. They just need to understand basic applicability of these skills.
Okay, let me thank Lauren. Thank you. Now we have 8 minutes left. I'm going to do a rapid fire 3 questions, maybe 4, that everyone has to answer and quickly. Okay, on a scale of 1 to 10, how big is AI going forward for finance? Toby?
Yeah, it's a very precise calculation. So I think it depends on what area of finance. I think right now it's probably pretty low, but it will be eventually. I don't know. What do you want me to say? I'm going to say 5 because I have no idea. But
I know. I think this is just the tip of the iceberg. And I think when we think about AI, do we think about the ChatGPT thing or what AI is going to look like 5 to 10 years from now? So if you think about the rapid progress that has taken place, project that 10 years from now, I think, yes, it's going to be quite big.
So 10?
10.
Okay. Andrea?
Okay, so this is where Dimitris and I agree. 10, and I think when Toby was speaking, I started to think one of the things that I actually have been worried about, not AI, it's like the rise of thematics and the kind of thematic taking over what quants were doing, right? So we know that indexation is growing, but at the edges of indexation, we had quant for a long time, and then we got all this Bitcoin and weed and, kind of everybody wants their own custom portfolio. Well, that's exactly what AI can give you. And so I think there could be some really interesting changes, and I also go with 10.
Yes, in agreement here. But I want to caveat this that even 5 years ago, as typically the case with general purpose technology, it wasn't clear how useful AI will be. I think by now we have use cases that actually prove it been valuable. In fact, anecdote, I had a discussion 3 years ago discussing my paper on AI used by firms, and I was told, wait for another 20 years to study this because it's not important. So, things change. I think right now we're maybe at 5. In the future, we are at 10. And I'm so excited about the promise and trying to figure out where, in fact, these tools are useful for firms, for investors, that I'm going to be organizing a conference at Columbia, AI in Finance. So sorry for this shameless plug-in Steve allowed me to do. If you're interested in getting call for papers, sign up at my page, tiniababina.com.
Perfect. All right, well, I've seen enough Prices Right to know that the only correct answer is 4.9. It's close without going over. But look, I think the reason why that's true is I think much like today, our students aren't getting hired because they're great at Excel. In fact, there is a World Excel Championships, that exists, and it was won by a 15-year-old, and he won a cool $7,000. Okay, so Excel as a skill is now been completely commoditized. I think a lot of AI will be too, and these other skills in terms of what we are teaching our students and what we will have to teach our students will dominate.
Okay, one word, and then I'm going to ask a final question. One word is internet or AI, which is bigger? Or another way of saying that is AI going to be as big as the internet, which some people believe, or not?
Okay. I'm going internet.
Flip a coin, AI.
Definitely AI.
AI, yes. Not ChatGPT. Actual AI.
AI, although I think you need the data from the internet to have it, to make it useful. So it's hard to disentangle those two.
Very, very good. Okay, where are the big opportunities in academic research? Why don't we start with Lauren, or start with Tania?
Well, frankly, everywhere. As I mentioned earlier, we have a lot of studies that explore specific uses of AI, use cases. Lauren went through several of them. In some places it works, in some it doesn't. So I think we need to continue doing that to figure out where this technology is helpful and where it's not. It's not going to be helpful everywhere. And also studying the economic impact of AI. And this is where there's practically very, very little research. And this is going to be important going back to the earlier questions on regulation. Everybody's talking about we need to regulate AI, we need to regulate it. We have no idea what AI even does. How can we regulate something where there is no solid research on the impacts of AI, both at the micro but also macro level? So I guess we need to study AI of everything in finance.
So I would say here's where it's not. Okay, it's not on taking AI models, and I've seen many papers that do this, that then fit this AI model to a CEO's decision making or investment managers and say, look, what a fool. He couldn't figure out this thing that a billion parameter model was able to figure out by getting all this data, right? That's too high of a bar. So that is a terrible application of AI. I think a better application is in picking up those subtle relationships, those subtle behaviors that we have with people that we can't with the human eye figure out, but AI will help us to kind of scratch the surface and shine a light there that will help to give us new insight into the way markets work.
So I'm going to go back to this idea of core versus supplemental tasks. So these generative AI and AI models make great RAs. They can do things like code, they can do literature searches. Maybe we will stop forgetting about papers that were published before the year 2000. I think we should definitely do that. But they are not going to generate the thesis. They're not going to generate the research question. So again, I hope for us that it is that they are going to be helping with the supplementary tasks, and we will still be doing the core ones.
So I think it's going to help democratize the creation of new data. So being married to an economic historian, I can very much appreciate the amount of work that gets created into constructing new data sets. And previously, this was only accessible to people that had well-funded research accounts. I think what's going to do is going to give everyone the ability to create new data sets. I don't think it's going to create new questions, but it's going to give us more access and broader.
Yeah, and I would say where it's useful today in particular is, and I mentioned this before, taking data that we weren't previously able to analyze and be able to put some structure on it, interpret it. I think that would also be the case anytime you have sort of, I think of them as hidden interactions or things that are not easy to discover. This is a way to discover those things that I think was much harder before. I think that is going to inform our models. So I think the most promising research is one where we can get insights from new data or new relationships that were very hard to see with our normal techniques that help us inform to build better models.
Well, that is terrific. We are at our time, so I want to thank our awesome panelists. Thank you. And thank you all. Thank Monica for putting this together, and onward and upward.